Welcome to the Deep Dive, where we take a stack of information and distill it into the most important insights, giving you a shortcut to being well-informed.
Today, we're doing a deep dive into Latent View Analytics Ltd. They're an AI-driven analytics, data engineering, and consulting firm.
Right.
And we've got their latest numbers, Q1 FY26 unaudited results, their investor deck, press releases, even the earnings call recording, the full picture.
So our mission for you, our listener, is to really unpack what all this tells us.
Yeah.
How did Latent View actually perform? What's driving their growth? And where are they placing their bets strategically? You should walk away understanding both the numbers and, the story behind them.
It's actually a pretty fascinating look at how a data and AI company like this operates in such a, dynamic market, how they decide where to put their talent, their resources, especially now.
Okay, let's unpack this then. Maybe start with the big picture. Q1 FY26, the quarter ending June 30th, 2025. What do the headline numbers tell us?
Well, the top-line figures look strong. Total operating revenue came in at $2,360 million.
Okay.
That's up 1.6% sequentially, so quarter on quarter, and a pretty significant 31.9% year-over-year jump.
Wow, 31.9%.
And what's really notable, I think, is this marks their 10th consecutive quarter of revenue growth. 10th.
So consistent momentum there. It suggests maybe resilience, especially given the market.
Exactly. Resilience, maybe a diversified offering. It stands out against some of the volatility we've seen elsewhere in tech and consulting.
And management sounded pretty pleased, right? What are they pointing to specifically? What's driving this confidence?
They're highlighting a few things. First, the revenue growth comes from both their organic business and the Decision Point acquisition.
Right. Decision Point.
Yeah, that added about $222 million this quarter. And since that deal closed near the end of Q1 last fiscal year.
So this quarter marks a full year of integration.
Precisely. Which makes those year-over-year comparisons, like that 31.9%, more meaningful. And financially, their adjusted EBITDA was $523 million. That's a margin of 22.2%.
Pretty healthy.
Yeah. Reported EBITDA was slightly lower, $504 million, 21.4% margin. So things look stable and definitely growing.
Okay, so let's drill down a bit. Where's this growth actually coming from? Which sectors are leading?
Financial services is really the standout. Remarkable strength there.
Oh, yeah.
Grew 21.3% sequentially, just in the quarter, and an impressive 48.4% year over year.
48%.
Yeah. Management's very bullish on this. They're expecting over 40% growth for the full fiscal year.
Wow.
And that's after hitting 60% year over year last year. It just shows massive demand for data analytics, for AI within finance right now.
That's huge acceleration.
Yeah.
But what about the tech vertical? That seemed a bit flat this quarter.
You're right to flag that. It was flat. They said it was largely due to a couple of sort of one-off consulting projects finishing up in Q4.
Okay.
And the follow-on work got a bit delayed, but their confident growth will pick back up in Q2 as that pipeline converts.
Makes sense. And beyond tech and finance, any other sectors showing movement?
Definitely. They mentioned early signs of a revival in consumer goods. CTG. Got some new wins there this quarter.
Interesting. How are they approaching that?
Well, it's not just isolated projects. They're pushing these integrated transformation programs, things that combine R&D, supply chain, and revenue growth management, RGM.
More holistic.
Exactly. For consumer brands, it's about moving beyond just selling stuff to really understanding the customer, using AI to predict, what you want next.
Okay, shifting to clients.
Yeah.
How are they doing on adding new business? And what about keeping existing clients?
They added 7 new logos in Q1, and they emphasized the quality of those wins. 3 were specifically called out as having high growth potential over the next, say, 12 to 18 months.
So focusing on strategic ads.
Seems like it. Less about just volume, more about long-term relationships. And that shows in their existing base, too. Get this. 77% of their current revenue comes from clients they've had for over 5 years.
Wow, that's sticky. Says a lot about their model.
It really does. Strong relationship depth, becoming embedded partners.
And operationally, geographically, how's the workforce set up to support all this?
They've got over 1,600 people, strategically spread out. The vast majority are actually in APAC. That's where most employees are based.
Okay.
But they also have teams in North America serving about 49 clients, EU and UK with 8 clients, and LATAM with 6.
So a mix of delivery models,
Okay.
onshore, offshore.
Yeah, exactly. Onshore, nearshore, offshore. It gives them flexibility, helps optimize costs and proximity.
And client concentration, is that a factor?
It is something to note. 62% of revenue from their top 5 clients,
62.
75% from the top 10, and 86% from the top 20. So yeah, a strong reliance on a core group of major relationships.
Okay, so Q1 looks solid, but the real story is often about the future, right? What they're building. They mentioned strategic pillars for growth towards that $200 million revenue goal.
Indeed. They laid out 3 main pillars guiding them over the next 3 years. Pillar 1 is deepening client relationships. Basically, a more rigorous sales process, finding more opportunities within those 26 key focus accounts they've identified.
The focus accounts.
Yeah, and just making sure their solutions and content stay super relevant, indispensable even, growing within existing partners.
Makes sense. And pillar 2, something about Databricks.
Yes, strengthening their Databricks partnership.
Yeah.
This is clearly a major growth engine for them.
How so?
Well, they're setting up a dedicated center of excellence, a COE, just for Databricks, expanding the go-to-market team, the sales team focused on it.
Okay.
And they're seeing real traction, especially with generative AI projects built on Databricks.
Any examples?
Yeah, they mentioned running a joint Gen AI workshop with Databricks for a prospect that directly led to a deal they expect will scale up to $2 million within 12 months.
Wow, okay. Real result.
Definitely. And their own tools like MigrateMate, Connected View, Marty, they're now part of the official Databricks Brick Builder portfolio. Plus, they're building skills in SAP data migration within the Databricks environment.
That deep integration sounds like a potential game changer. Okay, and the third pillar, AI strategy.
Exactly. Their AI strategy, specifically focusing on Gen AI and agentic AI.
Agentic AI,
Yeah.
right. Tell me more about that.
This is where they're really leaning into the future. They've got internal leaders assigned, a dedicated COE staffed with 10 people, including PhDs.
So serious investment.
Oh, yeah. And they already have $6 million in confirmed work for this year, plus another $8 million in the pipeline just for AI.
So it's translating into actual projects.
Absolutely. For Gen AI, think generating content, audio, video, text for a CPG client's website. For agentic AI, which is more about autonomous systems working towards a goal,
Right.
they're helping financial firms automate things like report generation for asset management or investment banking.
Interesting. So AI impacting both revenue and cost efficiency for clients.
Precisely. That's the dual benefit they're pushing.
Okay, let's switch gears slightly. Financial health operations. That EBITDA margin, 21.4%. How are they managing costs, especially with wage hikes hitting in Q1?
Yeah, it's impressive that margin already includes those wage hikes from April 1st. They said the increases were maybe slightly higher than usual, especially on performance and variable pay, but still in line with external benchmarks. So they're paying competitively, but keeping margins healthy.
Any other cost factors?
They did mention lower visa expenses this quarter. Apparently, it's cyclical, the way they book them. That helped the margin a bit. But higher marketing costs offset some of that gain. So it's a bit of a balancing act.
And on the people side, headcount over 1,600. What about attrition?
Attrition was 23%. Management described that as manageable.
23%.
Manageable. Yeah, they pointed out you often see an uptick in Q1 right after increments and bonuses are paid out. So they don't seem overly concerned.
Okay.
And crucially, their balance sheet is still very healthy. Lots of cash. That gives them the firepower to fund these strategic initiatives we've been talking about.
Got it. And there were some one-offs impacting profit?
Right. PBT and PAT got a boost from a Forex gain on some intercompany loans and also a one-time deferred tax credit about INR 48.7 million because they switched to a new corporate tax regime.
Okay, so looking ahead now, how confident do they sound about hitting their targets for the full year?
Very confident. They reiterated their guidance of 18-19% USD revenue growth for FY26.
Right.
And even hinted they might exceed 20%. They cited a strong order book, a robust pipeline.
Yeah.
And remember those delayed Q4 projects?
Yeah.
Some of those are already converting here in Q2.
That's a strong outlook. And for you, our listener, here's a key insight. Their longer-term goal, that $200 million revenue target by FY28,
Yeah.
that implies, what, a 26% compound annual growth rate?
Yeah.
That's ambitious. What's fueling that optimism?
Well, it's not just internal hope. It's tied to the huge growth trajectories of their partners. Like Databricks, they're aiming for 60% CAGR.
60%.
And the whole Gen AI, agentic AI market is pegged at maybe 35-45% growth over the next 5 years. Latent View is essentially betting on riding those massive waves.
So positioning themselves as what'd you call them? AI integrators.
Exactly. Helping clients deal with all the complexity,
Mm.
all the choices in the AI world, using existing tools, existing components, not trying to reinvent the wheel every time.
Seems pragmatic. Does that change the type of projects they do? Maybe more focus on that foundational data work.
It could mean more fixed scope projects initially, yeah. But if they nail those, it could lead to bigger execution deals later.
Right.
The key thing they're seeing is companies get that data engineering is foundational now. They're willing to invest proactively in solid data platforms, almost like a cost of doing business, before they even know all the specific AI uses cases.
So even with macro headwinds slowing things down.
Right, sales cycles are longer, but management feels those big data infrastructure talks are nearing conclusions. Companies know they have to sort out their data to play in the AI future.
Okay. And besides the financials and strategy, they picked up some awards in Q1 too.
They did, yeah. A Workplace Excellence Award, named a contender by Forrester for customer analytics services, a leader in AIM's PIMA report for data engineering and MLOps.
Nice.
Also won a Master of Risk in Cybersecurity Award, and the CEO of Decision Point won a Data Leadership Award for 2025. So good external validation.
Definitely adds credibility. Finally, any leadership shuffles?
Just one notable one. Their chief client officer is departing in September. He'd been there 17 years, actually their first U.S. employee.
Wow, long tenure.
Yeah. For now, the CEO is taking over his duties directly. They said that might evolve over time. The board structure seems stable, though. Good mix of executive and independent directors with Venkat Viswanathan as chair.
Okay, so wrapping this up, our deep dive into Latent View shows a company that's, well, consistently growing and strategically investing right in the heart of where things are headed, AI and data.
Yeah.
They seem to be navigating the market shifts with a pretty clear vision, relying on strong client bonds and those key partnerships.
I think the big takeaways here are about smart adaptation, really seeing where the market's going, putting money into the right capabilities, Gen AI, data engineering, and using partnerships like Databricks to get that exponential lift instead of trying to go it alone.
And that mix of steady organic growth plus the strategic acquisition, combined with focusing on hot areas like finance and maybe recovering CPG sector, it paints a pretty compelling picture, doesn't it?
It really does. And it raises an interesting question maybe for you, our listener, to think about. As more and more companies realize they need that core data infrastructure for AI, how does that change the game for consultants like Latent View? Does the old project-based model shift even more towards these really integrated long-term strategic partnerships we talked about? Is it less about one-off gigs and more about becoming truly embedded?
Definitely something to ponder as you continue your own deep dives. Until next time, stay curious.